Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, the smartest guy in the room, Mr. Michael Becker. Michael, how are you in this end of July, beginning of August of 2020 days?
Yeah, it's going pretty good. It's a little weird out there, and it's everything's going good, but we're thinking it shouldn't. So don't know what to think anymore, really, Paul.
That's why we bring in our special guest today. So we'll talk with him in a second. So are your kids thinking about going back to school at some period of time, Michael, or is it virtual?
As of now, we're gonna stay home for the first 2 weeks, which starts in late August, and then after Labor Day, the 8th of September is when the school goes back to in person. So we'll see how that's going to work. I'm definitely in the camp of sending them back because we can't homeschool anymore. That wasn't tenable for the 3 months we did it. So we're not preppers and homeschool type people in my family, at least.
Yeah, that's very tough to bring your business to your house and then have the kids hanging around. And your kids are how old again?
9 and 11. So we've got a lot of attitude right now.
A lot of energy too. So, we're coming towards the end of July here, going into August, and some crazy times out there. I mean, we get all kinds of financial reports that come in about talking a little bit about, where the economy is going, where, the GDP is showing. And so I thought it would be a good idea to bring one of our friends in that kind of has a little bit of more information. So I'm going to turn over this part of the podcast over to Mr. Michael Becker and introduce our guest, please.
Yeah, we're returning a third or fourth time now. JP Conklin from Pinsford. So JP, appreciate you coming back on.
Yeah, thanks for having me. Looking forward to it.
Yeah, so if people haven't heard you before, maybe do the 30-second version of kind of who you are and what does Pinsford do?
Yeah, absolutely. So I'm the founder and president of Pinsford, and we're an interest rate advisory firm. So we work with commercial real estate firms, helping them manage their interest rate exposure on the loans that they get. So most commonly, that ends up involving something along the lines of an interest rate cap or a swap or a defeasance. So anything that's interest rate related in the commercial real estate space, we're here to serve as a resource.
So obviously, it's been a period of extreme volatility, a lot of highs and a lot of lows here in 2020. So maybe we start kind of what's like a typical volume for you guys and say 2018, 2019. Then how does the most recent year kind of track compared to that? What's some of the similarities and variances as well?
Yeah, I've been surprised. So 18 and 19, we saw continued growth each year successively, was our busiest year ever. And really, at the halfway point of 2020, we were almost right on top of where we were a year ago. And I was kind of floored. I think we were talking before we started recording this, is that, I still have a very vivid memory of the financial crisis and how everything stopped. No transactions were happening because the banks were really at the crux of it. And so there was no lending to be had at all. And I can remember going years working on very few transactions per year just because nobody was lending. And I assumed incorrectly that would be the case again here. And I just thought, with a demand shock of what we're going to experience with COVID, how does a real estate owner operator underwrite a deal that would lead to a transaction, that would lead to a closing? I knew that banks would be a little bit more liquid than they were in 2008. I worked at one of those banks that went under, so I sort of say that tongue in cheek, but I was not prepared for the volume to mostly stay the same. I would say that maybe it's harder than it was a year ago, but in general, we're pretty much still cranking the way we had been a year ago. And I think, a tip of the cap goes to the agencies, Fannie and Freddie, for kind of leading the charge. I think sometimes we forget when things are good that they're not just a traditional lender, and that the industry as a whole kind of looks to them to be leaders during sharp downturns. And they sort of took that post-financial crisis and helped generate some upward momentum the next couple of years. And I think we're kind of getting through 2020 in large part because they're willing to still step out there and lend, albeit at different metrics. But overall, I would say I've been very surprised at how busy we have stayed.
Are you seeing more of your volume on the refinances, or are you still seeing a pretty high percentage on acquisition mortgages?
Yeah, we're definitely shifting more towards refinances or extensions or things of that nature. But I'm still very much surprised at the volume of acquisitions, particularly in multifamily. We as a company, probably 50% or so of our transactions are on multifamily deals to begin with. And multifamily has basically taken over our volume. And so it's really the vast majority of the transaction. And I am consistently surprised at how many new acquisitions are closing in the multifamily space each month. And I mean, right now I'm looking at our board and we probably have 30 deals in the works that'll close imminently. And, those are acquisitions, not refi. So it's kind of bizarre to me, but
are there any
money they want to put to work?
I know. So I think of rate caps when, kind of my world is when we take like a Freddie Mac floater. This is the most typical reason why I buy a rate cap. Are there any other apartment loans out there that kind of require rate caps besides the Freddie Mac floaters, or what's kind of the most active thing you're capping?
So that is definitely the most active. And I would say that has probably scaled back a touch just because fixed rates are so attractive right now that it's tough for people to pass up on doing a fixed rate. We're spending a lot of our time helping people understand the analysis of floating versus fixed and what that fixed prepayment penalty might translate into a higher rate. And while you might feel like you're getting, let's say, a 3% rate today, if you prepay 3 years from now, when things are humming and you're ready to get out of it, really you amortize that breakage cost and you really ended up paying 4%. And so as you make a decision today about floating versus fixed, if you think of the fixed as really at 4%, would you still choose it? And just having those sort of discussions with clients that they can make decisions with the best information possible.
Yeah, that's a good way of thinking of it, because we've been stuck on the tens of millions of dollars on defeasance or yield maintenance, just absolutely brutal. And if you would have looked at it with I'm going to sell in year 5 and anticipate having a $7 million prepay and just amortize it over the 10-year period, then your effective rate's materially higher. So it's a good way of thinking about it. So kind of maybe just talk a little bit about the state of the market for interest rates as a whole. It seems like everything's about 3%, at least the best I can tell. You fix it, you float it, you're going to pay about 3% with interest only, pretty readily available. Looks like the 10-year treasuries and the mid 50s as we talk right now, 55 basis points or so, and LIBOR's in 17 basis point range, and SOFR is about 10 basis points. We've had one hell of a decline here in the last, really from January to today. What do you see kind of current state of the markets, and then kind of what's intermediate term forecast for you?
Yeah, sure. So, let's start with floating rates. I'd like to bifurcate rates into two, short-term floating and long-term fixed. And short-term floating, like you discussed, LIBOR and SOFR are anchored close to zero, and they're not going anywhere for years. The Fed has already committed to keeping Fed funds unchanged through at least the end of 2022. And when they made that sort of calendar-specific guidance before, it's really only happened once, and that was post-financial crisis. They ended up revising and extending that commitment 4 times. And so they actually ended up committing an additional 2 years to the initial commitment. And then they had it at zero even beyond that. So my suspicion is what we're really talking about is short-term floating rates being close to zero for very likely the next 4 to 5 years, with some probability of it being 7 to 10 years. I mean, this is going to have a lasting impact. We went back to the last 2 downturns where the Fed made an intra-meeting cut. So they couldn't wait till the next meeting. They had to cut. It signals an emergency. And we said, okay, if we were to follow a similar path of that, basically 9/11, the 2001 recession, 2008 recession, what would Fed funds do over the next 60 months? And the absolute highest point it would get to would be if it followed the path following 9/11, which was sort of that short, quick shock to the system. And I think we'll have a much deeper recession this time. But even then, the top end is 2.5%. So for the next 5 years, it seems incredibly unlikely that we are dealing with anything on a floating rate basis, just with LIBOR, being above 2.5%. And it's very likely that it's going to be sub 1% and quite possibly close to zero. So for floating rate borrowers, you have as little to worry about as you are ever going to have. Like, we're probably entering another 0% interest rate environment for the foreseeable future. So for you guys buying caps, it's a piece of cake. Like, don't overthink it. Just float, buy a cap so you can sleep at night and move on. You do not have exposure to rising short-term interest rates right now. Switching gears to long-term, 10-year Treasury, let's use as the benchmark. As we sit here talking right now, it is on top of its all-time low. So 0.543%. And so this is the big question, right? Like, where is this going to head in the coming years? And generally speaking, long-term interest rates are driven by sort of three macro level things: economic growth, inflation, and global yields. And so growth today is apropos because we just had the worst GDP print in the history of our country and came in at negative 32.9%, which somehow was just marginally better than the forecast. Kind of hard to wrap my brain around negative 33% GDP, but that's what we're dealing with right now. So even though that's going to rebound, it is not going to suddenly be double-digit growth anytime soon. And the numbers that we read will be rebounding off of this horrific trough. And so we have to just take them with a grain of salt. So that's not going to go anywhere anytime soon, probably a year plus before it starts to really drag rates higher. Inflation, I know a lot of people are concerned about all of this stimulus and how that might create inflation. And to that, I would just say, we struggled for 10 years post-financial crisis to create inflation. The Fed tried everything they could to create inflation. And that sort of shock was not as dramatic as this. And so the Fed would love to have an inflation problem right now. That is not what they're worried about. They're worried about deflation. So that check may come due at some point. I don't believe it will, but it might. And if it does, it's years away. And they'll just deal with it when they get there. So I don't think that that's likely either. And then the last one, the global yields, is we're ticking back up to all-time record highs of negative yielding debt for global sovereigns. We're back up over 15 trillion. The peak was a couple of years ago when we got to 17 trillion. And so the point of all of that is just to say there are a ton of reasons for rates to be held down low for the foreseeable future. The 10-year Treasury, again, my guess is that we're dealing with a sub 1% Treasury for most of the next year or so. The big caveat there will be a vaccine. If we have a vaccine and people are willing to take it and they trust it, and that sort of eliminates the fear around COVID, we might see all of those things start to accelerate. But even then, you're still talking about probably a year or so before they really have a true impact on the economy. So for fixed rate borrowers, if I was a long-term holder, I would be locking up whatever I could lock up right now, because I don't know where the 10-year Treasury is going to be 2 years from now when it comes time to refi. So I think people should seriously consider refinancing, because we have a combination of extremely low interest rates as well as surprisingly aggressive lending appetite out there right now.
So if kind of taking that into account, so we're going to see an environment, if it kind of comes true, what you just said, that maybe in 2 years from now, 10-year Treasury might be, 1.5%, 2%, something along those lines, and LIBOR still be at 15 basis points.
Yep, you got it. In a much steeper yield curve environment, you're right.
And then we have expectations that LIBOR stays, near zero for, 3, 4, 5 years.
At least.
So, I mean, you still might be better off just floating and buying the cap and just recycling that cap every so often, or maybe 2-3 years down the road buying a 5-year cap, and you effectively can get yourself in a position where you probably have similar to lower rates than you would on fixed rate money a couple years down the road, and still have the flexibility of the exit. Is that a reasonable thought process there?
100%. As long as you're not going to be kicking yourself if the 10 years at 150 2 years from now, I think that makes all the sense in the world. If that's a risk that you're comfortable with, then what you just described is a perfect way to manage your interest rate exposure, because I can say with as much certainty as you'll ever say about something in the financial markets that floating rates are going to be low for the next 2 years, because the people in charge of that have said that they're not moving it. But the 10-year Treasury,
where do we see, like, like all in rates here? I mean, because obviously the index is one part of it and spreads are the other part. So last year, 2019, where hell, we got some floating rate quotes and locked some stuff in the mid 150, kind of 150, 160 spreads over LIBOR there for a period in time, and now they're 275, 280 on a lot of the stuff that we're seeing. So we've seen 100, 120 or so basis point expansion to the spread as the index has fallen. Do we see spreads staying kind of that high two range on the floaters, and this kind of seems like the low twos, like 220, 230 on the fixed rate money today? Do we see spreads kind of staying there, or do you see spreads coming back in?
I think on a long enough time horizon, they're going to come back in. Banks are already under pressure now that we're about 4 to 5 months into this to put some of this money to work. And so they're already starting to have to improve spreads. Like we're working on a deal right now where it's a loan spread of LIBOR plus 180, non-recourse. That feels pre-COVID to me.
At what leverage?
70% LTV.
Let me call that bank then. Jesus, that's pretty attractive.
It's fantastic. We're working on another deal that is going to end up being 7 or 10 years, and it's at LIBOR plus 250, which sounds high, but this is an enormous deal. This is north of $100 million, and it's basically a regional bank. And so and they believe that they're probably about 75 basis points inside market, and we're waiting on some Lifeco quotes to compare that to. But I kind of agree with them that they probably are kind of aggressive right now, and this is on retail. So like banks are under pressure already, and that will only continue to build going forward. I could see there being almost like a moratorium on how much they're allowed to reduce spreads or eliminate floors in 2020. But the closer we get to a vaccine and banks start realizing that they're missing out on deals, they'll start bringing those spreads in, they'll start reducing those floors, and people start getting hyper aggressive again in the next, I think sort of 6-ish months.
So that's end of the fourth quarter, first quarter kind of time frame?
Yep, exactly.
Okay. Have we seen, we obviously saw a ton of volatility in the MBS market, March, April. Do we see any reason that we would have more volatility in the MBS market like March in the kind of short to intermediate term, or does that seem like it's pretty stable?
I would say it's improving. I mean, that is one of the most volatile markets out there. And so somehow, I don't know how anybody can live in that universe as an employee, because those businesses it's boom or bust. And when it busts, man, they shut things down quickly. So I think that we would expect them to continue to stabilize because there's so much liquidity in market, and that's what they really rely on, but that they're more sensitive, they're more susceptible to volatility. So that can evaporate a little bit more quickly than some of the other lending types.
So I'm maybe a little bit of a paranoid libertarian, and one of the things I track is kind of the gold or silver prices, and we've been seeing those run pretty high here, pretty good gains over the last 6 months in particular. That's always been kind of one of the typical benchmarks that we're going to see some inflation, and as you just mentioned, that it doesn't appear like that's going to be on the horizon anytime in the intermediate term. Is there any sort of benchmark that you do look at that says, oh, this inflation might actually be here, and we need to pivot my float forever strategy and just buy the cheap caps? Is what would trigger that, and or what metric or benchmark should I be looking for to say that the party might be over?
One of the things that I like to track is forward inflation expectations. And so the Fed tracks this very closely on a couple different time horizons. So for example, 1-year forward inflation expectations or 5-year forward inflation expectations, because inflation expectations are one of those things that become a self-fulfilling prophecy. And so if I believe that things will be more expensive in the future, that encourages me to buy it today, which then in turn makes it more expensive in the future. And then conversely, if I think it's flat, then I'm unlikely to buy it, and that only further presses down prices. And so inflation expectations have tanked, rightfully so. But I keep an eye on what do those expectations in the future look like, because once they start getting back up 2.5%, 3%, that's a signal to me that current inflation is probably going to start driving higher. It might have some lag time, but it's probably on that trend. So that's what we track internally here is show me what that says. And right now it's about 1.5% for the next 5 years. So
where do you find that data?
You can get it on the Federal Reserve's websites. I go to the St. Louis Fed, and they have a ton of information. You can just go into the search bar and type in forward inflation, and it'll show you all the different ways that the Fed tracks that. St. Louis Fed has an amazing website. For anybody out there who likes to dig in and tinker with stuff, they have a ton of useful graphs with all the data already populated, and you just start searching and you can go investigate to your heart's content.
Cool. And I'll let Paul jump in here after this question, but I guess kind of my final question I had on my list really is elections. Obviously, we're in an election year. We're somewhere, 90 or so days away from the election as we record this. What happens, either way, if the expected outcome is Biden's gonna win and potentially even take the Senate back to the Democrat, what if anything happens to the capital markets and interest rate if that expected outcome happens, or we have another Trump surprise? What's kind of your thoughts on what would happen, either way the election goes?
I have no clue. I learned after the last election that I have no clue about anything, because I could be talked into either direction of interest rate movements, where even if Biden wins, he's likely, especially if Democrats take back the Senate, very likely to pass some sort of really large, sort of like Grand New Deal type of stimulus package, which presumably would be inflationary, and that would push rates higher. Conversely, he might, enact new regulation that would dampen economic growth. And so I could be talked into either position. I think that this really wide gap between Biden and Trump is probably likely to narrow over the next couple of months, particularly if we see GDP pop in Q3. And so I think that right now, if we were casting votes right now, Biden probably wins, and he probably wins by a landslide. But we're still about 3.5 months out, and I think that gap is going to narrow. But I'm just not sure that the election, when we have COVID hanging over us, is going to have the same sort of impact that it normally does on markets. I think COVID is still the biggest driver.
So JP has been very generous with his information. He really is where the rubber meets the road. I want to just talk a little bit more about Pensford and what you guys do, so just some blocking and tackling questions to kind of talk a little bit more about your business and how you got so damn smart about being able to actually be in this business and then offer your opinion. So again, what does Pensford do?
So we work with commercial real estate firms to hedge their interest rate risk. And so very basically, that most commonly means, just like with Michael, is we need to buy a cap for a Freddie floater. We help arrange the cap with the counterparties. Or I'm closing on a bank loan that has a swap, and I want some help making sure I get a fair deal on the swap. And this has been a huge driver of our business for the last year or so, because regional banks are much more aggressively pushing swaps than they were 3 or 4 years ago. And so we come in and we just negotiate on behalf of the borrower directly with the bank. We're not trying to steer the business away. Just say, let's make sure everybody has a transparent deal, including legal documents. And then on defeasances, if you have a prepayment penalty because you're trying to take advantage of a refinance, we are an approved successor borrower and we are a defeasance consultant. And so we handle those transactions, all of which really falls under this umbrella of just interest rate people. We just like when you guys call us and ask us questions. So Michael calls and says, here's what I'm thinking about. Let's have a conversation. And so to me, a winning relationship is we are viewed as a resource anytime someone has a question about interest rates.
Talk to me a little bit about, and some people who are listening may know this, but maybe a lot of them do not know, but how does buying a cap benefit the borrower and the lender?
Sure, great question. It really just ensures that your floating rate, which can go up and down, can't ever exceed a certain level. And so it's just like a call option, but on a floating rate like LIBOR or SOFR. And so you would say, I don't want my rate to get above 2%. Or Freddie might say, we don't want your rate to get above 3.5%. You just go and you buy a cap, you pay an upfront premium. Today it's super cheap. You can buy a lot of them for 15, 20 grand. And if LIBOR were to spike and get above that strike price, that hedge provider reimburses you the difference. And so from the bank's perspective, it's a great way to know I can underwrite this deal knowing that the interest rate's never going to exceed X over the life of this transaction.
No, those caps are usually good for a couple of years, and they're usually like a 3-2-1. How long do those caps are usually in place?
The most common is 3 years because Freddie is one of the huge lenders that require caps. So I would say that's probably the most common. Same with debt funds when they were a little bit more aggressive. So 3 years in is the most common. What we have seen a lot of this year after rates plunged was people buying longer term caps, sort of 5, 7, and 10 years, that we don't think anything's going to happen to rates for the next couple of years. But by the time rates start to rise 2 or 3 years from now, it's too late. And so I'm going to buy a 10-year cap today and just put a hedge on some core amount of outstanding debt I expect to have for the next decade.
Yeah, you're buying an insurance policy. So if the house catches on fire down the road, which means interest rates are on the rise, that you are covered. And I think that's interesting is that how you are really able to almost predict where interest rates are is the cost of the premium has really fallen in the last year or so. So can you give me an idea where premiums were like on a $10 million transaction back, a 3-year deal back, say a year and a half ago, 2 years ago, versus where they're at right now?
Yeah, sure. I mean, just over the last year, a 1% strike has dropped by 90%. So not only have these prices that, let's say, a Freddie might require or a debt fund might require, even if you want to get aggressive and say, I don't want my cost of funds to exceed, let's say, 1%, that has dropped by almost 100% over the last 12 months. So we've seen not only people extending their term, but also bringing that strike way down and just saying, you know what, if it's cost me 10% of what it would have cost me a year ago, let me just lock this thing in for the next 5 years. And I can sleep at night knowing my base benchmark rate can't exceed 1%.
So by taking a cap for 3 to 5 years, you could really start to sleep at night knowing that, say, on a $10 million transaction, if you took an adjustable rate instead of a fixed rate, that the insurance that you paid is going to be a lot less right now than if interest rates rose in the future. Michael, what's your take on where interest rate, you yourself and SPI, where do you think interest rates are headed to?
Yeah, well, we've been floating, so I've been stuck over and over and over again on the yield maintenance or defeasance. So we've kind of decided not to put the hand back to the stove anymore for a while, and just let's just float. And I mean, if JP's anywhere close to right, I mean, it's going to be a no-brainer in the long run to float, even if you're paying the same interest rate. I'm just kind of a weird paradigm to say, oh, well, I can take 10-year fixed rate money at 3%, or I can float it at 3%, and I'm going to float it, which sounds insane, but I think it's definitely the right move. And I mean, we haven't really even seen. I think one of my thoughts is, I got a couple years to float, and then a couple years from now, the lending environment and the options you're going to have are going to be a lot more robust than they are, say, today or 2 months ago. Because right now, Lifeco isn't really in the market. CMBS is pretty dead. At least from the multifamily space, and the banks are just kind of now starting to trickle back in. And like JP said, I think there's a lot more, pressure for these guys to start making some loans once they realize all their performing assets are burning off and they got to go get their earnings. So I think, we probably could find, 7-10-year fixed rate Lifeco money in the low to mid twos. Does that sound crazy, JP, in a year or so from now?
No,
it doesn't. High quality multifamily?
No, it doesn't sound crazy to me at all.
So you float it for a couple of years, and then if you're worried about it, go to Lifeco and get 10-year money. You probably can negotiate a little bit more flexible exit on a Lifeco than you can on the agency. So that seems like a thought we have. We'll see if we're right or wrong. I guess time will tell, but I just don't see rates really running, and at least the short end of the range anytime in the near term. And I guess as I found trying to short a couple stocks here, which I don't normally do, it's hard to fight the Fed. So if they want something to happen, they generally make it happen.
But we also have clients who are very uncomfortable with floating rate debt. Not nearly as many as we did maybe a decade ago, but what I tell them is that's fine. If buying a cap doesn't make you feel comfortable and you just need the certainty of a fixed rate, then just at least consider shortening up your time horizon. instead of doing a 10-year, maybe you do a 5-year and mitigate that defeasance penalty a few years down the road, because then it'll be, a third of what it would have been otherwise. And I think a lot of times we focus exclusively on float versus fixed, but I would also throw in duration mismatch. That sometimes if you really think that you're going to be refinancing in a much better environment 2 or 3 years from now, but you're worried maybe you're wrong and you might be holding this for 5 years, go get a 5-year fixed instead of a 10-year fixed, so that you can maintain some flexibility and mitigate that prepayment penalty or defeasance penalty 3 years from now if you are able to take it out.
So Michael and I are bankers by trade, and we've always been of the belief that the fixed rate is the better way of financing. It's predetermined at the beginning. You know what it's going to be at the end. But when you come to multifamily, whether it's Fannie Mae or Freddie Mac or CMBS business, there is a significant prepayment penalty to pay these loans off if you take a 10 or 12-year fixed rate Fannie Mae loan as an example. And we just talked about a little bit ago about the kind of the exit strategy. And Michael and I were of the belief that, going longer with the fix was better. But what was the problem with that thinking? And what was the cost of the exit? How much were you paying to get out of those deals?
A good example, Paul, is we had a deal set pre-COVID that we were going to go all cash, and now we reset it going cash to note, and we reduced the sales price from $9 million from basically 70 to low 60s. And that's 100% due to the yield maintenance. And we had a high 3 rate that we thought would never be lower. We put 12-year debt on it, and set $9 million on fire. So that's the good example of that. So the yield maintenance and defeasance costs have just skyrocketed from January to today, when the treasuries went from, what were they, kind of that mid ones to 55 basis points all time low. So it's at some point, we're just going to have to just basically take whatever the outstanding principal or interest due on the loan for the life of the term and just pay that all up front, because that's what some of these yield maintenance calculations have to become when the interest rates are so damn low. So it's I think JP's point is that's probably where I was the mistake was really made on the front end of these deals 5 years ago, 7 years ago when we were doing them, is we mismatched duration risk, where we thought we wanted to get in and out of this deal in 4 or 5 years, and we thought that loan would be an asset to us. Well, we should have just put a 4 or 5 year or 5-year mortgage on it if we wanted to fix it, and then sell it free and clear. Because your newsletter, you're right. I know, JP, you mentioned that you did an analysis maybe 9 or 12 months ago where you kind of went to the float versus fixed comparison, and every time it was floating was the right decision 95% of the time or something like that. And when you miss on floating rate, you miss small. When you miss on fixed rate, you miss big because of defeasance and yield maintenance. And that was a very telling newsletter that you wrote that 9 months ago or so.
Can you talk a little bit about that newsletter, JP? Because a lot of people need to get it, and then also talk a little bit about your podcast too.
Yeah, happily. So the newsletter is an email that I send out every Monday morning to our subscribers. It's free because it got no real credibility behind it whatsoever. It's just me typing at a computer over the weekend. So the one that Michael is talking about, actually the catalyst for that was from my banking days, because what was so funny is I worked on the commercial real estate team, and we sat next to, let's say, the investment banking team. And so most of my clients were real estate firms that would get floating rate loans and convert to fixed. And all of our presentations just talked about how rates were going to the moon, basically forever, right? And the guy sitting next to me, he was, covering IBM, and IBM has access to the capital markets. So IBM would issue fixed rate bonds and then use our desk to swap them back to floating, right? So his pitch book looked exactly opposite. It said, here's why rates always win out if you choose floating. And so their graphs were diametrically opposed to our graphs, even though we sat right next to each other. And that's when I realized, okay, maybe I need to sort of monitor my own best interest here. Like, what does the actual data say? Because we're clearly just saying whatever is going to help us close a sale. But that sparked this interest of, let's go back and analyze this. And what we found was, the longer the time frame, so let's say 10 years, there has never been a time on a rolling basis where picking fixed ended up being better than picking floating. Never. 0% of the time. And if you picked fixed at the wrong time, you were usually wrong by about 4%. It's an enormous amount. So to Michael's point, when you pick fixed and you're wrong huge. And then conversely, floating, if you shorten up the time frame, there have been periods where floating was more expensive, but only by a little bit, by about 25 basis points. It wasn't a huge number. So you weren't like really frustrated that you picked floating. And so we used that to help initiate discussions with our borrowers who are just convinced fixed rate is safe. And it's like, it feels safe because it's just a number that you can underwrite to, but it's not necessarily when you consider opportunity cost or defeasance penalties. And so that sort of dialogue has led to some pretty intense, thorough portfolio reviews. We just wrapped one up with a customer who has always historically been fixed, even though they always get out early. And we went back through, I think it was like their last 40 transactions, dispositions, and we found that on average, they exited about 42 months earlier than the maturity of the loan. And so one of the conclusions was that term mismatch, like if you would just pick 7 instead of 10 years, you could have saved over $25 million over the last, 5 years. And then you add in the defeasance penalty, and that was another $38 million. And so we're leaving so much money on the table under this perception that fixed rates are definitely safer than floating rates. And if we can at least just have a dialogue around it, you might be able to make some more informed decisions around what is best for your portfolio and for your investors.
Are you seeing the SOFR transition getting stalled out, or is that still something that's going to happen here in the intermediate term?
The agencies are still saying that they plan on moving forward. We speak primarily with the hedge providers, and there are no hedge providers, zero, that are able to offer a SOFR-based cap right now. There are a couple banks that think that they're going to be ready in the next couple months, but if we had to sell one right now, they wouldn't be able to do it. And so I think that may be a contributing factor to things just sort of getting delayed a little bit. We'll have plenty of cover fire from COVID to say, we don't have to force this right now. Let's everybody just make sure that this is a smooth transition. But for the time being, the headlines out of the agencies is still, we're going to help force this transition in the coming months.
Sounds great. Michael, anything more we need to ask the professor of interest rates?
We've taken probably more of his time than we planned, so we definitely appreciate you coming back on. We'll maybe try to get you in one more time for the year's over, because everything is just so volatile and uncertain out there in the marketplace. So definitely appreciate your insights. And, like I said, it's been a real kind of paradigm shift for me over the last, 2.5 years, kind of going from the fix forever type of mentality to hell, let's float it. And, we literally just made that decision here recently. Like, we can fix it for basically the same or lower rate than we can float it, and we're still going to float it because, we've always been, better off when we float. So that's been one heck of a good paradigm shift. And hopefully we can take advantage of some of the life codes coming back in the marketplace here in the not too distant future and get those floors lowered to, something with lower than, say, 2.5, which they were kind of at the beginning of the year. It's just amazing, Paul. Like, we have, I think, 3 loans that have a 1 handle on our interest rates. One deal we're paying, 1.72%, which is, down about 65% from where it was, a year ago. It's just, unbelievable. If you can pay, 2% interest only, you could just absolutely print money in this business. So I think it's, a pretty good time. A lot of the pricing's kind of stayed where it was in January, and your real discount and these apartment deals right now are just really in the debt. So, your debt's maybe 40% off or, 25 to 40% off where it was in January on your interest rate. That's really kind of where your break comes in, even if the pricing stays pretty flat from January.
Yeah, you don't have the COVID-19 property discount price in the market, but you certainly do have it in the capital markets. I mean, that has definitely come down. That 1.75 interest rate is awful damn nice, Mike, but I want to see, maybe our last question is, JP, when is that going to be a negative 1.75? So the bank actually pays Michael to be in that property.
Can't get here soon enough. I don't know that we will have negative interest rates here. I know that the Fed does not think that we will. I think that there is a chance. I think it would be foolish for us to think we're the only country in the developed world that won't have negative interest rates. I mean, shoot, the 10-year Treasury is at 54 basis points. Who thought that was possible? So I think anything's possible. But I think that the Fed themselves will be reluctant to push rates negative. They will instead use other tools to try to prop up the economy and spur some growth.
Isn't that incredible? The whole world is searching for yield. And if you gave $100,000 on a 10-year Treasury right now, and 10 years later, you'd only be making 0.5% on your money. It's absolutely unbelievable and ridiculous.
Well, Paul, JP and I were talking right before we started recording. It's kind of last little thought was, kind of compared the Great Recession to today, and kind of, I think, burned in all three of our memories because we were, definitely participants in the marketplace 12 years ago when everything kind of hit the fan. But, what was different was there was a bunch of distress and deals on the asset prices and no liquidity, which kind of created a lot of the pricing declines. And now there's a ton of liquidity looking for distress, and there's really no distressed pricing. Not saying that we don't see that in retail or hospitality, but, there's just so much money out there that I just don't see how pricing can really go down, especially if, your 10-year treasuries and has, 55 basis points or so, and LIBOR is at, 17 basis points or 16 or whatever it is today. I mean, it's just, I just think prices have to kind of, have a floor to them. And I just don't really think they fall too low on multifamily or industrial, I guess, to be specific.
Sounds good. JP, one more time, the name of your firm, the website?
Pensford.com.
Pensford.com. All right, some great information from JP Conklin with Pensford. We certainly do appreciate you coming on and giving us your insight about what's going on. We do take that information to heart, and we kind of formulate plans and strategies based on some of that great information. So we appreciate that. Michael Becker, always a pleasure. We do appreciate your insight about what's going on. So again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.